Investing sounds simple. Put your money in, watch it grow. But behind the glossy promises are costs most people never notice. Small fees, management charges, taxes, and even timing mistakes quietly drain your returns over time. They're often invisible, buried in fine print, but together, they can cost you thousands. We'll uncover the hidden costs of investing no one talks about, and why knowing them can matter more than picking the right investment. Today, we will talk about the hidden costs of investing no one talks about. So, before we start, make sure to hit the like button and subscribe to my channel. 1. The unseen side of investing. When people think about investing, they usually focus on profits, market growth, and success stories. What is rarely discussed is the other side of investing, the hidden costs that quietly reduce returns over time. These costs are not always obvious and often do not appear as a single large expense. Instead, they work slowly in the background, making them easy to ignore. Many investors believe that if their portfolio value is increasing, they are doing well. However, true performance can only be measured after accounting for all costs. Hidden investing costs can affect beginners and experienced investors alike. They exist across stocks, bonds, mutual funds, real estate, and even alternative investments. Over long periods, these small costs compound and can significantly reduce wealth. This is why two investors with similar portfolios can end up with very different results. Understanding these hidden costs is essential for making informed decisions. Without awareness, investors may unknowingly give up a large portion of their potential gains. Investing is not just about what you earn, but also about what you keep after all expenses, risks, and inefficiencies are considered. 2. Management fees that compound against you. One of the most common yet underestimated investing costs is management fees. Mutual funds, index funds, exchange-traded funds, and professionally managed portfolios often charge annual fees. These fees may seem small, often between 0.5% and 2%, but their long-term impact is massive. Because fees are deducted every year, they reduce the amount of money that can grow through compounding. Over decades, even a 1% annual fee can cost an investor hundreds of thousands in lost returns. Many investors focus on gross returns and ignore net returns after fees. This creates a misleading picture of performance. Actively managed funds often justify higher fees by promising better results, yet many fail to outperform lower-cost alternatives. Fees are guaranteed, while returns are not. This makes them one of the most dangerous hidden costs. Investors who do not regularly review expense ratios may unknowingly overpay for underperformance. Understanding how fees work and how they compound is critical to long-term investing success. 3. Transaction costs and overtrading. Transaction costs are another hidden expense that quietly eats into investment returns. Every time an investor buys or sells an asset, costs are involved. These may include brokerage commissions, bid-ask spreads, platform fees, and execution costs. Even platforms that advertise commission-free trading often recover costs in other ways. Frequent trading magnifies these expenses, especially for active traders. Over time, transaction costs can significantly reduce portfolio growth. Many investors trade more than necessary due to market noise, emotional reactions, or the belief that frequent action leads to better results. In reality, excessive trading often harms performance. Studies have shown that investors who trade less tend to earn higher returns. Transaction costs are particularly damaging because they are often invisible. Investors see the trade confirmation but rarely calculate the long-term impact. Reducing unnecessary trades is one of the simplest ways to improve net returns, yet it is often overlooked. 4. Taxes as a silent wealth drain. Taxes are one of the largest hidden costs in investing. Yet they receive surprisingly little attention. Capital gains taxes, dividend taxes, and interest income taxes can significantly reduce net returns. Short-term gains are often taxed at higher rates than long-term gains, but many investors trade without considering tax consequences. Each sale can trigger a tax event, reducing the amount of capital available for reinvestment. Over time, this creates a compounding disadvantage. Tax inefficiency can turn a strong-performing portfolio into a mediocre one. Inflation-adjusted after-tax returns are what truly matter, but most performance discussions ignore this reality. Tax-advantaged accounts can help, but misuse or lack of understanding limits their effectiveness. Investors who fail to plan for taxes often overestimate their real wealth. Taxes may not feel like a direct investing cost, but their impact is powerful and persistent. 5. Inflation's quiet impact on returns. Inflation is one of the most underestimated hidden costs of investing. Even when an investment generates positive returns, inflation reduces its real value. For example, if your portfolio grows by 7% while inflation is 5%, your real return is only 2%. Many investors focus on nominal returns and feel successful, while their purchasing power barely improves. Over long periods, inflation dramatically alters financial outcomes. Investments that fail to outpace inflation do not truly build wealth. This is especially dangerous for conservative investors who rely on low-risk, low-return assets. Inflation works quietly, year after year, reducing the future value of money. Ignoring inflation leads to false confidence and poor planning. True investing success requires understanding real returns, not just numbers on a statement. 6. Opportunity cost of playing it too safe. Opportunity cost is one of the least visible yet most impactful investing costs. Money invested in low-growth or underperforming assets may feel safe, but it can cost significant future gains. Holding excessive cash or avoiding markets out of fear can result in missed opportunities. Over time, this lost growth compounds into a major disadvantage. Opportunity cost does not appear on statements, which makes it easy to ignore. However, the impact is real. Being too conservative can be just as harmful as being too aggressive. Investors must balance risk and growth instead of avoiding risk altogether. Understanding opportunity cost helps investors see that doing nothing is often a decision with consequences. 7. Emotional decisions and behavioral costs. Emotions play a major role in investing, and they come with hidden costs. Fear leads to panic selling, while greed leads to buying at market peaks. These behaviors often result in buying high and selling low, the opposite of successful investing. Emotional decisions do not show up as fees, but they directly reduce returns. Market volatility triggers reactions that feel rational in the moment but are damaging long-term. Many investors exit the market during downturns and re-enter after prices recover, locking in losses. Behavioral costs are difficult to measure, but their impact is significant. Controlling emotions and sticking to a plan is one of the most valuable skills an investor can develop. 8. Liquidity limits and exit costs. Liquidity is another hidden cost that investors often overlook. Some investments restrict access to funds or impose penalties for early withdrawal. Real estate, private investments, and long-term contracts can limit flexibility. When cash is needed urgently, investors may be forced to sell at unfavorable prices. This can turn a good investment into a costly mistake. Liquidity risk becomes especially problematic during economic downturns, when markets are stressed. Understanding liquidity conditions is essential before committing capital. Investments should match not only return goals, but also time horizons and cash needs. 9. Complexity, knowledge gaps, and costly mistakes. Complex investment products often come with hidden risks and costs. Many investors do not fully understand what they are buying. Poor research, lack of diversification, and misunderstanding financial products can lead to expensive errors. These mistakes may not involve direct fees, but they result in lost growth and missed opportunities. Education is an investment itself, yet many people underestimate its value. Knowledge gaps lead to poor decisions that compound over time. The cost of not understanding your investments can be far greater than any visible expense. 10. Why awareness changes everything. The most dangerous investing costs are the ones no one talks about. They are small, quiet, and persistent. Over time, they shape outcomes more than market performance alone. Awareness is the first step toward better investing, By understanding fees, taxes, inflation, behavior, and opportunity cost, investors can make smarter decisions. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.